I'm Dawson Schmidt here with the latest stories and developments in this week's Commodity Roundup on Trader PhD.
Shipping constraints remain a large issue for the Black Sea region. In the short term, that has major importers looking elsewhere for wheat. Ongoing attacks between Russia and Ukraine have caused heightened concerns for major shipping routes. That has been crippling expectations for wheat exports in this month. Analytical center Rush Agrotrans says Russia's August wheat exports could drop to 1.6 million tons, down 60% from a year ago and the lowest for the month since 2010. Russian consultancy firm soybean also expects a similar outlook. The Russian government did ban exports outright during the 2010 and 11 season due to a poor crop harvest. However, shipments for this month are not restricted by a government decree, highlighting a true constraint to access supplies. Additionally, soybean says Ukraine's August grain exports could be the second worst for any month since the war started. Those declines have been felt throughout the wheat market, with global values pushing higher this summer. U.S. prices remain the highest among global competitors. Bloomberg reported that major crop buyers across Asia are searching for alternative suppliers due to those heavy risks in the Black Sea shipping region. Indonesia has been picking up cargoes from Australia to secure supplies, while Bangladesh has sought offers from Romania. However, available supplies of high-protein wheat varieties have been more limited this year, keeping upward pressure on prices. Tyson Foods is closing more beef facilities as the U.S. cattle shortage continues to squeeze the beef industry. The nation's largest meat packer announced Thursday that it will close a beef plant in Illinois and a case-ready facility in Utah. Another beef plant in Washington also appears headed for closure. Tyson says production from those facilities will be absorbed by other plants as the company works to stay competitive amid the tightest cattle supplies in the U.S. Beef packers have continually struggled with margins over the past few years. According to Hedger's Edge, estimated losses exceeded $300 per head multiple times this year. Not to mention, margin volatility has also increased substantially. Company earnings have also highlighted millions of dollars in losses in the beef segments for the past few quarters. Tyson has already reduced capacity this year, including cutting operations at its Texas facility and closing a major beef plant in Nebraska. That leaves Tyson's core beef operations concentrated in the 3 plants in Nebraska, Kansas, and Texas. The Amarillo, Texas plant, which has been reduced to 1 shift, is expected to return to 2 shifts as more cattle supplies become available. U.S. soybean crushings continued at their record pace last month. According to the latest national crush report from the National Oilseed Processors Association, processors crushed 216.6 million bushels of soybeans in July. That was an increase of 11% from last year, continuing to run at a record pace for the current marketing year. Soybean oil inventories totaled 1.36 billion pounds for July, now at a 9-month low. That large drop in inventories has been due to higher domestic feedstock usage in biofuel production. Soybean oil maintains a competitive advantage as a biofuel feedstock with support from expanding U.S. crush capacity and policies that favor domestic soybean oil usage. Despite the preference for domestic feedstocks, the U.S. does import feedstocks from outside of the U.S. to account for periods of elevated biofuel demand. Filling that gap, Brazilian beef tallow has grown to support the U.S. feedstock supply, though tallow imports have fallen so far this year. Data from the U.S. Census Bureau showed that imports through the first half of this year are running 14% lower than a year ago. Additionally, imports of used cooking oil, another key feedstock, are down about 41%. Brazilian tallow is now subject to a combined 37.5% U.S. tariff. Australian exports are also already subject to a 12.5% tariff. If imports shrink and become less competitive, domestic feedstocks will only firm even amid a more limited supply. Shrinking imports and limited supplies further boost soybean oil's competitiveness as a domestic biofuel feedstock. Thanks for watching. I'm Dawson Schmidt, and this has been Trader PhD.